let's just address the global picture once again. Internally, things are not looking good, but the main factor is, of course, a weaker global environment. Peter Cardillo, who's representing Spartan Capital, joins us from New York. Thanks very much, Peter, for taking out the time. I know it's late in New York right now, but even so, what is the market mood looking like? Is there more circumspection about growth sustaining at these levels, given trade war tensions, given the dollar's strength, perhaps curbing the potential of exports, and the housing market, it's not recovering as one was expecting. So maybe the headline numbers on growth look good, but the internals do not suggest that the momentum is here to stay.
Well, there's no question that the market obviously is right now going through a pretty severe correction. I say severe correction because the fact that the Dow managed to lose all of its gains this year, and of course the S&P fell rather sharply, over 3%, suggests that this market erosion is going to continue. Now, there are several factors for this, and the main one is that we're beginning to see tariffs impact earnings, even though some of the companies have reported earnings that have matched expectations. The fact is that the guidance, they are beginning to sound the alarm that prices are going up. And so that means either the companies pass the increases on to the consumers, or they will have to eat them, and that means lower earnings. So that's a basic fundamental. Then, of course, there are the geopolitical concerns between the U.S. and the Saudis. And yesterday we had the Beige Book, and certainly the Fed were rather upbeat. Really didn't change the outlook for the economy. And so I think that was also a factor. In fact, the market began to accelerate on the downside after the announcement of the Beige Book. So there are several key fundamental reasons why the market is now in a corrective stage.
Okay. Peter, we've been interacting with a couple of old-timers from Wall Street, Ray Dalio, Harvard Marx, and the sense which we're getting from some of the billionaire gurus is that the US market is in a late cycle. And typically when you are in a late cycle, you should get cognizant of risk. Rather than extending your chips, you should take the chips off the table. So do you think this is just the beginning of a larger decline for developed markets and equities in general?
Well, I don't think it's just the beginning, but I don't see the end in sight anytime soon. Can we get down another 5, maybe 10%? Very possible. Remember that we've been up substantially. So unless we lose 20% or plus, I don't think we're headed for a bear market.
Okay, Peter, we'll leave it at that. Glad that you could take time out, and thanks so much for staying up late and analyzing what's going on with the global markets. And last check, the SGX Nifty is already indicating a downtick of about 100 points as we speak.